Hi, I'm Janine Firpo, and I'd like to welcome you to this, our fifth of 12 sessions in advance of the publication of Activate Your Money, Invest to Grow Your Wealth and Build a Better World. Today, we're going to be talking about Chapter 6, which is focused on fixed income. And my guest is Akasha Absher, who has been instrumental in helping me write this chapter. So I'd really like to welcome her today to the show. Hi, Akasha.
Hi, thank you so much for having me. It's great to be here.
It's a pleasure. It's a pleasure. You are currently the president of Intrinsic, which is an investment firm that helps nonprofits and mission aligned individuals, which I think is really fascinating. Could you tell us a little bit about what you mean by that and also how you work, part of what your company does?
Of course. Intrinsic Investment Consulting Council is an investment consulting firm. And really, as you mentioned, we are focused on the nonprofit sector. Our mission is to co create a sustainable and generative world that empowers all people by providing investment advice and strategic consulting. We advise on about $1.9 billion, 90% of which those assets belong to nonprofit organizations. I'm the principal and president of the firm, and my role is to lead the firm's effort in providing investment advice and strategic consulting. I also work with clients on how to evaluate their resources in line with their mission and business strategy.
I absolutely love that. I love to see a woman like you, young and in such a powerful position. I mean, 1.9 billion, that's
Thank you.
fantastic. So, congratulations on that. It's really impressive. And I'm so delighted that I
Thank you.
had the opportunity to work with you and learn from you. And one of the things that I love about you as
Same.
well is that you are what I would call, and I hope this doesn't offend you, a bit of a bond nerd. So you have worked a lot in the bond markets. You know a ton about this. You're really an expert there. And I think it's one of the things that makes you really special and fascinating. And what I'd love, I think that bonds are often overlooked. A lot of people think the stocks are the sexy thing to invest in. Bonds are just this really boring category. Could you explain a little bit about what they are and how they work? What is the bond market? Why
Of,
should people even care
of
about
course, of course. So, one thing first, I would say my CEO, when he hired me 7 years ago, he thought I was a nerd and wasn't quite sure I was going to be able to be a consultant because, I'd been a fixed income research analyst. So, those are typically people who put their heads down and are not engaging per se. You mentioned what is a bond. So, interestingly, I think we use the term bond interchangeably for a lot of fixed income investments. And the fixed income market actually has a lot of different types of debt instruments, one being a bond, others being a loan, a bill, things like that. But essentially, when you think about a debt instrument, there are many types, but they typically provide a way in which a corporation or a government or municipality can issue their type of debt instrument to fund their activities. So, in terms of a corporation, you might go out to the market to issue a bond so that you can fund your working capital or so that you can grow your business in some ways. So, typically, it is used to provide capital for organizations. For the investor is typically provided with interest payments that are either fixed or variable and have a set maturity date. So, for most all bond instruments or debt instruments, that is what happens.
it? Okay, so just so that people understand, a debt instrument is really a loan. And when you talk about a maturity date, what you're referring to is that this loan has a point at which all of the principal has to be
Yes.
returned, and that is known as the maturity date, right?
So, similar to a mortgage, for all, like if you think about an individual, your mortgage has a maturity date. It's usually 30 years, 15 years, something like that. It has an interest rate, and you pay every month or on your mortgage. It is the same for almost all debt instruments, particularly for corporations. They go out, they issue debt. they get cash on hand. So the flip side, whereas in we go out and issue debt and you get a house, they go out and issue debt and get cash on hand for a certain amount of time, and then they get paid back. They have to pay interest on that over that certain amount of time.
And that interest is usually fixed. And that's why some people use this kind of fixed income or debt instrument as a way to generate income, particularly people who are maybe older.
Yes.
So it's often used for that. But all debt, all bonds are not the same, right? There are some come from the government. There are treasury bonds. There are some from the municipal governments, muni bonds, corporate bonds that you're referring to. So bonds can be issued from a lot of different types of organizations, and they also come with different grades. So what does that mean when we talk about an investment grade or a non-investment grade bond?
Of course. So within fixed income, there are three main rating agencies. And those three main rating agencies really rate the quality of a debt instrument, looking at the company or government's leverage. So how much debt do you have to income? The earnings expectation of that company. Do you have the earnings ability to repay that debt? The credit history of that company or that municipality. There are a lot of municipalities that are rated differently based on their credit history, based on their repayment history. So they look at all of those things and whether you're able to afford the additional debt, and they assign you a grade. And that grade goes anywhere from AAA to triple C. AAA to triple B is investment grade. Below triple B is high yield. So essentially, investment grade debt from AAA to triple B is seen as less risky. It is seen, it will typically have a lower interest rate as well because it's seen as less risky. But the debt rating that you get or the credit rating you get will determine how much you have to pay when you go out to market for your interest rate. So again, very similar to if you as an individual wanted a mortgage and you looked at your FICO score, your FICO score and your credit history would depend on the interest rate you would get for your mortgage and how much money you might have to put down. So it's not dissimilar.
So it's really interesting because what we're seeing here is that there's enormous variability within the bond market, right? I think a lot of people think of bonds or fixed income as very stable, very low risk, something that they can invest in and just hold on to it for some period of time and get a pretty steady, though relatively low return relative to other types of investments. But that's not truly the case. I mean, people can get into the bond market and trade just as frequently as they do in the stock market, right? And they can speculate and they can be using the bond market really as a way to maximize return, can't they?
Yes. So the bond market within fixed income, there are many different, as you mentioned, segments of fixed income. So corporate debt, government debt, mortgage-backed securities, and you can use all of them with the exception of government debt, particularly treasuries, across the risk spectrum from conservative to aggressive. So you can use it to earn income. You can use it to reduce the risk in your portfolios. You can think about it as an outright speculative investment. So for example, if you decided within high yield, you said, okay, so I think that this company, while it is high yield, it has a double B rating. Over time, it'll be a triple B. And what that means is that even though it's issued, so when you think about a bond, let's just say company X goes out to the market and issues debt at 5% for 10 years. So it's a 5-year debt for 10 years. And so you buy it at par and you get 5%. And if you held it its entire life, you would get 5%. And then they would give you your $100 back, right? However, if you bought it from a speculative play, what could happen is that your 5% bond, over time, the price will go up because the credit rating went down, assuming that they actually had good earnings and were able to be more stable. And what would happen is the bond you bought for 100 is now 105, because it became more valuable because the credit rating went up.
I was really intrigued when I started learning about this from you. And I actually thought, oh, I think I'm going to look into this a little bit and think about buying bonds myself. And because, when I first started investing over 30 years ago, I used to do it by buying individual stock. That's what you did in the 80s. You bought stock, right? Well, I looked into it and I realized, this is a very different beast than the stock market. It's actually really complicated, much more so than I had expected. So I am not doing that. I am actually working with a financial advisor who knows something about this to buy bonds for me. But it made me really curious about how you got so interested in this in the first place and how you came to be the bond expert that you are today.
So my story is, I guess I give you the full story. I, coming out in college, was interested in finance, and I was interested in mergers and acquisitions because I saw Richard Gere in Pretty Woman, and I thought, I want to do that. And so I was really fortunate to be in a program called Sponsors for Educational Opportunity, which really launched my career. And they put minorities on Wall Street via internships. So I did an internship at Blackstone in their M&A department, which was great. I learned a lot. You learn how to value companies. You learn about different capital structures and equity and debt. But I didn't have any broader capital markets experience. And a lot of my friends were in different places within the capital markets. Like one would be syndicated leverage finance. And I was like, what is that? And so I realized that in order to have a broader scope and a better understanding of the capital markets and of finance, I wanted to do a rotational program. And having grown up in New York, I didn't really want to be in New York any longer. I wanted to try something new. So I started out my career in Enron's rotational finance program over 20 years ago. And I did project finance for the first, I did risk mitigation for the first year, which is funny. And then I did project finance in South America. And then I had a colleague who said, okay, why don't you come and join our hedge fund doing fixed income research and trading? I thought, well, that doesn't sound fun. Why would I want to go into fixed income? But I was like, be a big girl, Akasha. You wanted to learn more about the capital markets and fixed income. And so I went and I joined the hedge fund and I traded and researched utilities, metals and mining, paper and packaging, so all the industrial sectors. And it was so fun. And when you think about it, right, you always think, as you mentioned, everybody thinks that equity is sexy, but you have a priority claim in fixed income over equity. Who wouldn't want to be paid first, right? Like it was almost a no-brainer. Like, why wouldn't you be in this asset class? Because you get to do all of this research. You can be speculative. You can also mitigate risk, but you also get paid first. The other thing that I think is super fascinating and so exciting about the fixed income markets, way different than equities, is fixed income is really twofold, particularly when it comes to corporate debt. You have interest rate risk and you have credit risk. And the credit risk, we talked about credit ratings, depending upon how you're rated, will depend upon where you can issue. The other is the underlying interest rates, which are really based on policy, fiscal policy, and also the economy. So you have this whole macroeconomic overlay onto fixed income that you don't really have in the equity markets, at least when it comes to pricing. Like you do with regards to the equity markets do move with growth in the market, but it's not based on the pricing. So super exciting to be in fixed income because you were able to see so many different things versus in the equity market. And you're able to have so many different types of segments. We talked about corporate bonds, which are based on corporations, mortgage-backed securities. So think of your mortgage and my mortgage all pulled together and traded. You think about treasury securities, the government's debt. So different aspects within fixed income.
It's really interesting what you said about being paid first, because one of the things that I have come to with my own investing, because I invest in private companies too. I do a little bit of angel investing, which we'll talk about in later sessions of this series.
Good
But
for you.
I have really come to like private debt over
Mm-hmm.
private equity because of what you're saying, right? I get paid first if there is a default, but there's also a pretty nice return. It feels in many cases like the risk is lower. And one of the things that I'm actually looking at is, can I actually do as well or better in a private debt instrument than I would do in a private equity instrument? Because in private equity, I have to buy into a lot of firms with the hope that one will be successful. And it reminds me of a
Mm-hmm.
conversation that you and I had the other day, where you talked about the return that people could see in the fixed income market over a long period. And it was relatively attractive. So could you just remind me of what you said? I think you had talked about a 5% return, if I'm not mistaken.
Yeah, so if you think about the last rolling 20 years, of 10 years over the last 20 years, so rolling 10 years of the last 20 years, from 99 to 2020, what you will see is that a bucket of fixed income, so that includes corporate, so it's mainly investment grade, but they call it the aggregate index, which includes treasuries, corporate investment grade debt. It also includes mortgage-backed securities, et cetera, yielded about 5%. And why is that important? Equities, of course, global equities did much better at 6.7, but the variability was a lot wider. And so when you think about why you would have fixed income in your portfolio, particularly one, you can earn a return that is fairly decent. Now, as interest rates have come down, that return potential has come down. So past performance is not an indicator of future results just from that aspect when you think about that. But if you were a individual who had a portfolio that you were actually using, having a fixed investment that has less variability is better from a liquidity standpoint. But it again depends on what you're trying to accomplish and what you need. But if you had a portfolio that was a mix of stock and bonds, you got somewhere between 6, 7, and 5%. And so you could have an average of the two, depending upon whether you were 70-30 equities, fixed income, 50-50, depending upon what was right for you.
We actually talked about that a little bit in a previous segment where we talked about asset allocation and how important it is to make these decisions about what percentage of your assets you want in a stock, the stock market, fixed income, private, etc. So having some fixed income is really a great idea, and knowing that you can get a reasonable return on it, I think is really important.
For context, late last year, just to highlight your point, from January 2020 to March 2020, so right around the time of the crisis and the downdraft, the S&P 500 returned negative 19.6%. But the US intermediate bond, so the ag fund, returned 3.3. And so over time, why is that important? Again, if you needed liquidity during that time, you got it from the fixed income market and you didn't have to touch your stocks, right? So that's one of the benefits of having some fixed income in your portfolio.
It's a great point. And just for people who don't understand liquidity, what she means is that if you needed to have cash right now, you did not want to pull cash
Right.
out of the stock market when your money was down almost 20%. You wanted to pull it out of the
Agreed.
bond market when your money was up 3%. So, and one of the things that I think a lot of people, when they think about bonds, they don't think about buying individual bonds. They think about buying
Mm.
bond funds. That's what most of us are told to do. That's what I have been told to do virtually my entire investing life. And it was only really a couple of years ago when I met a financial advisor who told me that I could actually buy individual bonds, which I had never even thought of before. And so I went ahead and let her do that for me. And I've really loved the individual bond buying. It's not right for everyone. And you have to have a certain amount of assets to be able to put to work this way. But if you can, it's a really interesting strategy to be able to buy an individual bond, hold it for its maturity if you wanted to. You get paid the dividend or the interest rate while you're holding that bond. And then, assuming there's no default, then you'll get all of your money back at maturity. And part of the reason I like it is because I'm at a point in my life where I want to see some kind of income stream from the capital that I have. But I also realize that I can do amazing stuff in terms of my values with bonds. And I am personally really interested in communities and in women, supporting women. And so I own a lot of municipal bonds, many of them in the state of California where I live. And these are giving me a good return. They're also tax-free, many of them, but I'm supporting things like building out schools or ensuring that our water systems are clean, or um, underwriting affordable housing, or doing other things that makes life better for women and children and underserved people in my community, which makes me feel great. So I'm curious, as you've been looking out and you do a lot of work in a mission aligned way as well, what are you seeing in the bond market in terms of the things that we can invest in with our values? And are there any specific examples of things that you've seen that you really love, that you're excited about?
Yeah. So, great point with individual and bond funds. I would say one thing now that is evolving is there are a number of bond funds that are have a thematic portion to them. So whereby you can say, I want to do gender lens, or you can say, I want to invest in my community. You can even invest by via zip code. So there are a number where you have the bond funds to be able to do it, because as you mentioned, until you get to a certain asset size, it's a bit prohibitive to buy individual bonds. But one of the things that I think is super exciting is that we're really starting to see a rise in environmental, social, and governance integration in the fixed income market. So even if you were to buy a bond fund, what we're starting to see is bond fund managers really think about how their companies engage with the environment, how they engage with all of their stakeholders, their employees, their communities when they're doing business. And so Invesco did a study that essentially said that fixed income managers, 56% were incorporating ESG. And that's up in 2020, and that's up from 38% in 2019. And the other thing we have seen is a rise, particularly not just in ESG integration, so whereby companies are evaluating those factors, or managers are evaluating those factors with regards to their decision making and investing in companies. You're also starting to see companies go out and issue sustainable bonds. So what that means is they are issuing bonds to finance green product projects and social projects. One thing we saw in 2020, which was great, was Alphabet, which is Google's parent, sold 5.75 billion of sustainability bonds to deliver affordable lending to help low income, low wealth, and disadvantaged people in low income communities. That was super cool. And add into the fact that they took some of those proceeds and invested in a community development financial institution to finance small businesses in Black communities with a portion of its issuance. And so we're starting to see a lot more companies think about, okay, so I'm going to go out and issue debt to finance my sustainability, my social projects, and to finance my green projects. And as investors, we can now start to invest in those specific projects.
That's so cool. And I've actually been able to invest in some of those kinds of things. And one of the things that I invested in that I really love is, so there's a hospital called the Lucille Packard Hospital. It's in the Menlo Park, Palo Alto area in Northern California. And it's really dedicated to children who have terminal illnesses and to helping those children in really difficult cases, right? And they put out a bond to improve their facilities and to have more beds for the parents who come and stay with their children while they're this sick. And I bought into that bond, and it was particularly meaningful for me because during her life, my mother used to donate money to that hospital because it was sort of in her backyard. And so in a way, my being able to invest in that bond is a way that I've also been able to continue the legacy that my mom had. So it's a particularly meaningful one to me. But not everyone, as we
That is
said,
so great.
thank you. Not everyone, as we said, can invest in individual bonds. And you mentioned that there are also bond funds that are available for people to invest this way. Now, one of the things that is different about a bond fund than a bond, well, not completely, but if you buy a bond and you hold it, you make your money by getting that dividend. If you buy a bond fund, it works a little bit differently than just buying a bond. Could you explain a bit how bond funds work that are different from the way bonds themselves work?
Of course. So, as you mentioned, if you buy a bond and hold it, essentially what you're getting is the interest stream. So, your interest rate over the time of which you had the bond. Bond funds are a little bit different because they have a bunch of bonds within the fund. So, you'll have bonds of varying maturity, and you'll have bonds with varying interest rates. You will get interest income off of a bond fund, but what the bond fund is really there is for a total return. So you remember how I said earlier, if I bought company X at 100 and it was a 5% issue, and then I held it over 10 years, I made 5%. However, if I sold it early and that company did really well and then improved its credit ratings, I would not only get the 5% for the period of time I held it, but I would also get price appreciation. So the $100 that I paid for it would go up to 105, and I would get that difference as well. And so with bond funds, really what you're trying to accomplish, depending upon the bond fund, because they're both, and there are both passive and active bond funds. So active bond funds, where they're actively seeking to improve the overall return of investing in the fixed income market, you can get price appreciation as well as the interest. With regards to passive funds, you're just really going to look like the market.
So I think that what you're saying is a really important point, which is there is an interest rate you get, and that 5% that Akasha was talking about is 5% per year if you held a bond. And then there's also, just like stock, these bonds and bond funds, their value fluctuates over time, and you can take advantage of that as well. One of the things I realized we talked about a little bit earlier that I want to go back to is you talked about interest rate risk. And I want to just dig into that a little bit because I think it's a really important consideration and can be quite significant when you think about buying and holding a bond. So what is interest rate risk and how does that impact what you do in this market?
Of course. So interest rate risk is really the risk that interest rates will change while you're holding a bond. So back to example, company X issues at 5%. So company X goes out, you buy it, they have a debt issuance for 10 years at 5%. Now, almost all companies, companies in general, issue on a spread versus government debt. So for example, right now, government debt, the 10-year treasury is at about 1.8. 1.6. Sorry, it's about 1.6 right now, 1.62 as of today, earlier this morning. And so if company X was issuing debt and it issued at 5%, the spread differential between the 1.6 and the 5% is the spread based on its credit rating. So what is going to happen though is if interest rates let's just hope this never happens, spike to 7%, you now have an issue that is worth 5% and underlying government debt is worth 7%. So what will happen is the price of that bond will decline because nobody's going to want to hold a bond that is paying 5% when they can go out into the marketplace and get 7%. However, if interest rates were to go from 1.6 down to 0.5%, the value of your 5% bond will increase because everybody's going to want the 5% bond, even more so when interest rates are at 0.5% versus 1.6. So essentially, everybody, when you're thinking about interest rate risk, you're really thinking about, okay, so I bought a bond and the price of that bond will fluctuate based on the changes in interest rates. If you buy and hold, it's not necessarily a big deal, particularly if you created a portfolio of bonds that met your financial objectives. Yes, would the price fluctuate? Most definitely. But assuming there's no credit risk, no default risk, you would get your dollars back at the end, you would get the interest income that you wanted, and you would have no problems. However, if you have an investment portfolio and you are not buying and holding, you run the risk of either selling when the interest rates are lower than what you bought, or or buying when interest rates are higher than what you bought. So that's the interest rate risk, right? You run the risk that in your portfolio, your interest rates will change over time. Was that
So
helpful?
yes, I think it's really helpful. And I think that, I do feel that a lot of people think the bond market is complex. And I think there is a lot of complexity in the bond market. However, as Lisa Cooper, one of the other contributors to the book, mentioned in a couple sessions back, a little bit of knowledge goes a long way. So beginning to understand what some of these terms are that we've talked about, beginning to understand a little bit more how interest rate risk works, whether a bond itself or a bond fund is more appropriate for you. These are all things that we go into more detail in the chapter on fixed income in the book. And we also provide on the companion website, there will be some videos that take you through Morningstar and other tools that are freely available on the web and explains to you how you can figure out for a particular bond fund or bond what some of these different attributes that Akasha talked about are. So you'll learn a lot more from the book and going onto the companion website.
In the book, we just talked about interest rate risk today, and we talked about interest rate risk, assuming all else is equal. There's also credit risk, there's also liquidity risk. So there are several risks associated with investing in fixed income. And so just making sure you understand all of those risks, the book will be super helpful in that as well.
And I think that one of the things that I've really learned, and I hope is coming out in this, is that there's a lot of flexibility here. You can use bonds in a lot more ways than most of us think are possible. And while many people will be most likely to just buy some bond funds and hold them or trade them from time to time, if you are incented to do so, there's a lot more opportunity here than you may have ever realized before. And what I'm really excited about as a values aligned investor is that I think there's tremendous opportunity here in terms of being able to put this capital, the assets that you decide to put into fixed income, to work in alignment with your values. There's a tremendous amount of choice. When you think about the various sustainable development goals that we've talked about before, there are many ways that you can apply the bond market to those different types of goals. And so I think it's a way more exciting asset class than I ever realized before I started working on this book. And I'm just so grateful to women like Akasha who have done the groundwork to help us all learn. So Akasha, I really appreciate your time with us today. I'd like to ask if there are any last thoughts that you have or any takeaways that you would like the listeners to have.
I would just echo what you said around values alignment. And another thing that is starting to come about, particularly and ways to invest more on the private side is being able to invest in small and medium-sized businesses run by women and people of color. And so being able to use your money to lend out to small and medium-sized businesses and people of color is super exciting as well. So there's so many ways with fixed income, as you mentioned, to align with your values. I think more so than in the traditional equity markets.
And one thing you just mentioned that, so I've done that. I am a big supporter of female CEOs and entrepreneurs. But one of the things that just changed or went into effect yesterday is that the crowdfunding rules changed. So crowdfunding is the
Okay.
way that a private business can raise money from investors. And it had been the case that only accredited investors, only people who had a certain level of wealth, primarily $1 million in net assets, excluding your primary residence, could invest in these kinds of private enterprises. Crowdfunding came into effect a couple of years ago. It allowed non-accredited investors to invest in private businesses, but there were restrictions on how much these private businesses could raise, and there were restrictions on how much the investors could invest. Well, that changed yesterday. So if I'm not mistaken, the cap used to be $1 million raise. It's gone up now to 5 million. And there are
Nice.
increased levels at which investors can now invest too. So crowdfunding has become easier and even more accessible to more people. So that's a way that you can get involved in these other types of opportunities that Akasha was mentioning. And I'm also really happy to say that I have seen a growing interest among women and among people of color who are stepping up and saying the old way of investing, no more, because for far too long, this has been, I'm sorry, a white man's game. And it is time that
Yes.
women and minorities, people of color, and other underserved populations start to have some level of access to the same
Right.
kind of equity, right? And so it's really, I'm seeing a shift. We still have a long way to go, but I'm very excited by what I'm seeing.
Same, same. And I mean, this is just a start as well. Thank you so much for putting together this book and bringing all these women together to share ideas and also to share with the world. I mean, what you're doing right there is different than what we have had in the past. So thank you for your contributions.
Thank you for that. And I could not have done this without women like you. So, from my perspective, this is not my book, it's all of our book. And you have been a huge supporter of this project, and I so appreciate it.
Thank you.